All right, nice summary here for all of what we've got. We've got 2 more slides, and here is what we've got. We start with our changes in accounting principle. When do you do the retrospective approach? Well, changing the financial statements of all prior periods presented. So if we change it for all in the past, maybe we want to restate all of our financial statements for all to make them all FIFO. All prior periods must be presented. Disclosing in the year of the change the effect of net income and earnings per share for all periods presented. So you need to affect those items when you are using the retrospective approach. When you're using the retrospective approach, you report an adjustment to the beginning retained earnings balance in the retained earnings statement in the earliest year presented, right? So net income flows to retained earnings. It's a super important number, and you need to constantly update it to show what the retained earnings, the equity was in that current year. So if impracticable to determine the prior period effect, and if you call me out for saying this word should be impractical, well, this is actually a real word, and more so about if it's beyond your control. So just don't call me out. Do a little research before you call me out for any misspellings there. Just a funny little note. So if it's basically impractical, which is, not too far from the difference of that word, do not change prior year's income. Again, if it's if it doesn't make sense, like if it's just beyond your scope, beyond your reach, if it's too cost effective, not cost effective enough, if it's not going to make sense, don't change the prior year's income. Use opening inventory in the year the method is adopted as a base year inventory for all subsequent LIFO computations. So changing to LIFO, that's going to be pretty hard if you have been doing FIFO the whole time and you've been doing first in, first out. Disclose the effect of the change on the current year and the reasons for omitting the computation of the cumulative effect and the pro forma amounts for prior years. There's some items there if it doesn't make sense to do it. Now let's wrap up the last 3 changes in accounting estimate. Well, employ the current and prospective, meaning in the current period and going forward, by reporting current and future financial statements on the new basis. Present prior period financial statements as previously reported, so you don't affect prior period, and making no adjustments to current period opening balances for the effects in prior periods, meaning January 1st balances stay the same because there was no changes to the prior periods. So changes in reporting entity. As we said, this is retrospective. So restate financial statements of all prior periods. Disclose in the year of change the effect on net income and earnings per share data for all periods presented. This is what investors care about. They want to know that. So you want to make sure that those pieces of information are properly updated. Lastly, changes due to errors. Well, just don't make errors, right? Hey, dummy, it's not too hard. Just don't make any errors. Employ the restatement approach. So this is just restating, correcting your errors. Correcting all prior period statement presented. If the error affects the period, restate the period. And restating the beginning balance of retained earnings for the first period presented when the error effects occur in a period prior to the first period presented. We did it. We made it through. I believed in you. I said it, right? I believe in you. Well, all right. Here, we simply want to understand the accounting treatment for errors, changes in principles, estimates, and reporting entity. Prospective, retrospective, what do you do? I don't know. You know now, right? So this is something you should be able to blow through, right? And a lot of the questions here, they'll pop up in other sections. So for example, a change in depreciation method, well, you'll see that in depreciation. A change in accounting principles, you might see that in notes of the financial statements or in inventory. A changing principle, what do you do? Change in estimate, you'll see that in our contingencies and commitments section. Reporting entity, you'll see that in, I feel like I kind of probably double said one of these. Reporting entity, you'll see that in consolidations. Errors, whatever it is. Lots of different errors we could possibly have. You'll see these questions in other sections. Practice them here, practice them all around. It's never enough, right? It's never enough. Answer more questions. You'll be done with it before you know it, and you'll be able to look back on it and reflect on your achievement. Keep trudging along forward. I'm with you in spirit and here in these videos. Thank you for joining, and I'll see you in the next one.